The most important number in the global financial system is not the federal funds rate, nor is it the yield on the 10-year Treasury. It is a number that hasn't moved by a single cent in 52 years. $42.22. This is the official statutory price at which the U.S. Treasury values its gold reserves, while the market price of gold hovers near historic highs, thousands of dollars per ounce. The United States government's balance sheet is frozen in 1973. This creates a discrepancy that is currently valued at over $500 billion. This gap is not an accounting error, it is a dormant financing facility. History shows that when sovereign debt reaches mathematically unpayable levels, governments do not choose default, and they rarely choose austerity. They choose to unlock the hidden equity on their own balance sheets. If you want to understand the mechanics of the next financial reset, you must look past the noise of daily stock tickers and focus on the plumbing of sovereign accounts, which is exactly what we do here at Finance Saga. The thesis we are exploring today is straightforward. The solution to the US debt crisis may not be a new tax or a spending cut, but a one-time accounting adjustment that has been used before and is legally available to be used again. To navigate this complex terrain, we will rely on a single mechanism map that we will build out 3 times over the course of this analysis. This map explains how a physical asset transforms into spending power without a single bar of gold leaving the vault. Here is the first layer of our mechanism map. Visualize 3 boxes moving from left to right. The first box is the dormant asset. This is the physical gold held by the Treasury, currently booked at an artificial historical cost. The second box is the mark-to-market event. This is the legal authority to update that price to current market realities. The third box is the Treasury equity injection. This is the free liquidity generated by the difference between the old price and the new price. Arrow 1 connects the asset to the event via statutory authority, and Arrow 2 connects the event to the equity via gold certificate issuance. This mechanism sounds theoretical, perhaps even like financial engineering fantasy, but it is grounded in hard law. The United States owns approximately 261 million ounces of gold, roughly 8,133 tons. If you check the weekly report on the Treasury's international reserve position, you will see this gold listed at a total value of roughly $11 billion. This valuation is mandated by Public Law 93-110, passed in 1973, which set the official price at $42.2222 per fine troy ounce. However, at a market price of $2,700 per ounce, that same pile of metal is worth approximately $705 billion. That is a difference, a spread, of nearly $700 billion. In the context of a $37 trillion debt pile, $700 billion might sound like a rounding error. But the specific power of this mechanism is not just the current market price. It is the ability of the Treasury, specifically under the Gold Reserve Act, to dictate the valuation during an emergency. If the price were revalued not just to the current market rate, but to a price calculated to cover a specific percentage of the monetary base, a strategy we call price targeting, the equity released becomes large enough to recapitalize a failing Federal Reserve or pay down significant tranches of debt. This leads us to the core problem, the incentives. Why would a government touch this third rail of monetary policy? The answer lies in the sovereign debt trap. When interest payments on national debt exceed a nation's defense budget, a threshold the US crossed recently, the mathematical path to solvency narrows. There are only 3 traditional exits: hard default, refusing to pay; austerity, spending less than you earn for decades; or financial repression, keeping interest rates below inflation. Hard default destroys the banking system. Austerity is political suicide. Financial repression is the preferred route, but it requires a compliant central bank. This brings us back to the mechanism map. How does the Treasury actually spend that gold? They don't sell it. Selling 8,000 tons of gold would crash the market and destroy the asset's value. Instead, they monetize the spread. Here is how the plumbing works today. The Treasury holds the physical gold. It issues gold certificates to the Federal Reserve. These certificates are essentially a receipt that says, "We owe you this much gold at $42.22 an ounce." The Fed holds these certificates as an asset on its balance sheet. If the Treasury decides to revalue gold to, say, $20,000 per ounce, they do not move the gold. They simply print new certificates reflecting the new higher price and hand them to the Fed. The Fed, in exchange, credits the Treasury's checking account, the Treasury General Account, TGA, with the difference. If gold goes from $42 to $20,000, the Treasury creates trillions of dollars in new spending power instantly, debt-free. No bonds are issued, no taxes are raised. It is a pure equity injection derived from an accounting revaluation. This is the shadow equity on the American balance sheet. Critics will immediately argue that this is simply money printing by another name, and they would be economically correct. It would be inflationary. However, from a legal and accounting perspective, it is distinct from quantitative easing, QE. QE involves the Fed buying debt. This mechanism involves the Treasury monetizing an asset it already owns. The distinction matters because, in a crisis of confidence, where foreign nations stop buying US debt, the Treasury needs a funding source that does not rely on bond markets. This is not a conspiracy theory found in the dark corners of the internet. It is a matter of public record and legal precedent. We know this mechanism works because it was the very foundation of the modern US financial system's recovery during the Great Depression. The confiscation aspect of 1933 gets all the attention in history books and survivalist forums, but the confiscation was merely a precursor to the real operation, the revaluation. The government didn't just want the gold, they wanted the profit from repricing the gold. Understanding this distinction between owning the metal and owning the pricing power is critical for what comes next. The market is currently signaling that participants are beginning to sniff out this possibility. We see this in the premium of physical gold over paper derivatives and the aggressive accumulation of gold by central banks who are essentially front-running a potential revaluation event. But before we project the future, we have to validate the past. To confirm that this is a viable policy tool rather than a theoretical loophole, we must examine the last time the United States executed this exact maneuver. The year was 1934, and the result was a windfall profit that the Treasury is still using today. On January 30th, 1934, President Franklin D. Roosevelt signed the Gold Reserve Act, a piece of legislation that fundamentally altered the genetic code of the American monetary system. While most history books focus on the executive order from the previous year, the one that demanded citizens hand in their gold coins, that order was merely the collection phase of a much larger operation. The Gold Reserve Act was the monetization phase. It was the moment the government executed the arbitrage trade they had spent months setting up, and it serves as the definitive case study for how a sovereign power solves an unsolvable debt problem. To understand the sheer scale of this financial engineering, we have to look at the mechanics of the transfer. Before 1934, the Federal Reserve banks physically owned the gold in their vaults. They were, at least in theory, independent institutions holding assets to back the currency. The Gold Reserve Act changed this instantly. It stripped the Federal Reserve of its physical gold title, transferring absolute ownership of every ounce to the US Treasury. In exchange, the Treasury handed the Federal Reserve gold certificates, paper IOUs that were non-redeemable, and effectively functioned as a permanent accounting placeholder. But here is the critical detail that most analysts miss: the price at which this transfer occurred. The Treasury took the gold from the Fed at the old statutory price of $20.67 per ounce. Once the Treasury had secured the title to the metal, President Roosevelt immediately exercised his new authority to revalue gold to $35 per ounce. The math of this operation is where the magic lies. By marking up the price of gold by approximately 69%, the Treasury did not create more gold, but they did create more dollars. On a gold stock of roughly 200 million ounces, this price hike generated a paper profit of approximately $2.8 billion. In today's economy, $2.8 billion sounds like a rounding error, but in 1934, it was an astronomical sum. For context, total federal government receipts in 1934 were roughly $3 billion. In a single stroke of a pen, the Treasury generated an equity windfall equal to nearly 1 year of total federal tax revenue. What happened to that $2.8 billion profit? It wasn't just dumped into the general budget to pay for roads or dams. It was used to seed a brand new opaque entity called the Exchange Stabilization Fund, or ESF. This fund was designed to operate outside the oversight of Congress, giving the Treasury Secretary broad discretion to intervene in currency markets to stabilize the dollar. This fund still exists today, and it is the very same war chest the Treasury used to backstop money market mutual funds during the 2008 financial crisis, and again, during the COVID-19 panic of 2020. The seed capital for the government is Emergency Financial Special Forces came directly from a gold revaluation. This historical precedent reinforces the second layer of our mechanism map. We still have the funding source, the revaluation profit, but now we see the intermediary clearly, the Exchange Stabilization Fund. The macro outcome in 1934 was the successful reflation of the US price level and the breaking of the deflationary spiral. By devaluing the dollar against gold, the US made its exports cheaper and its debts lighter. However, to fully appreciate why a government would choose this path, we must look at the alternative. We have a perfect counterexample from the same era. The United Kingdom DS returned to the gold standard in 1925. A decade before Roosevelt's revaluation, Winston Churchill, then Chancellor of the Exchequer, faced a similar post-war debt dilemma. But instead of devaluing, Churchill chose to restore the pound sterling to its pre-World War I parity of 4.86. He prioritized the honor of the currency and the interests of creditors over the mathematical reality of the economy. The result was catastrophic. To maintain this artificially high exchange rate, the Bank of England was forced to keep interest rates punishingly high. This caused a severe deflationary depression in Britain years before the crash of 1929 hit America. Wages collapsed, strikes paralyzed the country, and the economy suffocated under the weight of a currency that was too strong for its debt load. The contrast between Case A, the US in 1934, and Case B, the UK in 1925, offers a stark lesson for modern policymakers. Churchill chose austerity and par value, and he destroyed his economy. Roosevelt chose revaluation and debasement, and he stabilized his. When a sovereign nation is drowning in debt, the historical incentive structure always favors the debtor, not the creditor. The government will always choose to change the accounting rather than break the society. There is a misconception that such a move is illegal or theft. In the realm of sovereign finance, these terms are fluid. The Supreme Court actually heard cases regarding the 1933-1934 gold actions, most notably in the Gold Clause cases. The court ruled 5-4 in favor of the government, effectively stating that the government's right to regulate the value of money supersedes private contracts. The legal precedent is settled. The government has the authority to redefine the value of its currency relative to its assets. Why does this 90-year-old history matter right now? Because the plumbing installed in 1934 is still the plumbing we use today. The Gold Reserve Act was never repealed. The Exchange Stabilization Fund is fully active. The Treasury still holds the gold certificates, and the gold is still booked at a statutory rate that is wildly divorced from reality. The mechanism is not broken, it is simply dormant. But something has changed in the last decade. For nearly 40 years, Western central banks were net sellers of gold, treating it as a barbarous relic to be discarded in favor of US treasuries. That trend stopped abruptly in 2010. Since then, we have witnessed a structural shift in central bank behavior that mirrors the pre-1934 accumulation phase. The official sector is no longer selling, they are buying, and they are buying at a pace we haven't seen in 55 years. This pivot from liquidation to accumulation suggests that the architects of the monetary system are quietly preparing for a new valuation event. They are moving from a system backed exclusively by debt to a system that requires a neutral reserve asset to settle balances when trust in that debt evaporates. As we look at the modern data, we see three distinct signals flashing red. Signals that indicate the system is priming itself for another mark-to-market event. The difference this time is that it likely won't involve confiscating your jewelry, but it will involve a radical repricing of the world's reserve currency. The modern era of this mechanism began in silence. On July 26, 2019, The European Central Bank and 21 other signatories announced they would not renew the central bank gold agreement. For 20 years, this agreement had limited how much gold European nations could sell, a guardrail installed to prevent them from crashing the market. In 2019, they let it expire, stating simply that the market is mature. They didn't need a limit on selling because they had no intention of selling. They were preparing to buy. This marks the critical turning point in our timeline, the 2010 pivot. For 2 decades prior, Western central banks were net sellers of gold, dumping their barbarous relic to buy U.S. treasuries. But in the wake of the great financial crisis, that behavior inverted. Since 2010, central banks have been net buyers. In 2022 and 2023, they bought gold at the fastest pace since 1967. This is not a hedge, this is a remonetization. This shift was formalized by the regulators themselves. Under the Basel III banking accords, allocated physical gold was reclassified as a Tier 1 asset. In plain English, this means that for global banking capital requirements, gold is now considered risk-free, equivalent to cash or sovereign bonds. After decades of being treated as a volatile commodity, the global regulatory body quietly reinstated gold as money. This brings us to the third iteration of our mechanism map. We have the funding source, dormant gold, and the intermediary, Federal Reserve, on Treasury. Now we look at the macro outcome through the lens of the Eurozone. Unlike the United States, the Euro system's central banks already mark their gold to market. If you look at the balance sheet of the Bundesbank or the Bank of France, you will see gold and gold receivables valued at current market prices, updated quarterly. They have unlocked the asset, but they treat the unrealized gains as a revaluation reserve, a buffer against future losses. They do not spend it, yet. The machinery is built, plugged in, and humming. The United States is the outlier. The U.S. Treasury is the only major holder that still books gold at a 1973 price, sitting on a coiled spring of equity that is mathematically far more explosive than anything in Europe. To understand how close we are to this spring releasing, we need to look at the 3 signals now. These are not vague feelings, they are hard data points that have historically preceded monetary paradigm shifts. Signal 1, the official sector floor. Central banks purchased over 1,000 tons of gold annually in recent years, a level of accumulation not seen since the collapse of the London gold pool. When the entities that print the money start frantically trading that money for hard assets, they are signaling a loss of confidence in their own product. They are front-running the devaluation. Signal 2, the gold to monetary base ratio. This is the valuation metric that matters. In 1980, at the peak of the last inflation crisis, the market value of U.S. gold reserves roughly equaled the monetary base, 100% coverage. Today, with the monetary base near 5.6 trillion and gold reserves valued at market prices around 700 billion, the coverage ratio is barely 12%. To return to even a 40% coverage ratio, a historical baseline for a sound currency, the price of gold would need to rise to approximately $8,500 per ounce. To hit 100% coverage, we are looking at over $21,000 per ounce. These numbers align suspiciously well with the targets needed to neutralize the debt overhang. Signal 3, the return of term premium. For 40 years, investors accepted low yields on long-term bonds because they believed inflation was dead. That era is over. The term premium, the extra yield investors demand to hold long-term debt, is rising. This is the bond market telling the Treasury, we will not fund your deficits at these rates. When the bond market goes on strike, the government has only 2 choices. Let interest rates soar and bankrupt the economy, or find a new source of funding that doesn't require bond buyers. The obvious question is, if this mechanism is so powerful, why haven't they used it yet? Why sit on $700 billion of dormant equity while interest payments eat the budget alive? The answer is option value. You do not play your ace of spades in the second round of the game. You hold it for the moment of maximum danger. Revaluing gold is a nuclear option. It signals to the world that the debt market is broken. You only execute it when the bond vigilantes leave you no choice. When a failed auction or a credit downgrade forces a liquidity crisis, that money printing alone cannot solve. We are currently in the if phase of the timeline. The plumbing is ready, the precedents are set, and the motives are aligning. But we need to know exactly what triggers the then. Here is the quantified if-then funnel that transforms this historical theory into a measurable watch list. We do not need to guess. We simply need to observe the thresholds of sovereign stress. The primary metric to watch is the ratio of interest expense to federal tax receipts. If this ratio remains below 20%, the status quo of debt issuance continues. We are currently well past this. We crossed 30% recently, a level historically associated with currency crises in emerging markets. If this ratio sustains above 35% for 2 consecutive quarters, meaning more than 1 out of every 3 tax dollars goes solely to servicing old debt, then the bond market will demand a higher risk premium, pushing yields up and compounding the problem. If the 10-year Treasury yield structurally breaks above 5.5% while inflation is trending up, the mathematics of the budget cease to function. This is the trigger point. At this stage, the Federal Reserve would technically be insolvent on a mark-to-market basis due to losses on its bond portfolio. This is the specific condition that necessitates an equity injection. The nullifying condition for this scenario is a massive, sustained productivity boom, an AI-driven economic miracle that doubles GDP growth to 5% annually for a decade, inflating away the debt organically. While possible, hope is not a strategy. Without that miracle, we default to the base case. The government must manufacture equity to plug the hole. This brings us to the most critical question. In a revaluation scenario, who actually pays? The competitor script we analyzed argued that the government would physically confiscate gold from citizens to maximize its profit. While possible, this view ignores the efficiency of modern finance. In 1933, money was physical. The government needed the coins to control the money supply. Today, money is digital. They do not need to take your physical bar of gold to confiscate your wealth. They only need to dilute your currency. Let's look at the winners and losers through a strict cash flow lens. The payment for this debt jubilee comes from the purchasing power of the currency. The losers are the creditors. If you hold long-term government bonds, you will get paid back every single cent you are owed. The US will not default. However, you will be paid back in dollars that have been devalued against the primary reserve asset. You lose not in nominal terms, but in real terms. The second group of losers are wage earners. In a monetary reset, where gold is revalued to $20,000 to backstop the system, the price of goods, energy, food, housing, will reprice faster than wages. The gap between the cost of living and your paycheck is the tax you pay to fund the debt restructuring. The winners are the debtors. The biggest winner is the United States Treasury. By revaluing its 8,133 tons of gold, it wipes out the real burden of its liabilities. The secondary winners are hard asset holders, those who own the assets that the currency is being devalued against. Gold, prime real estate, productive equities, perhaps Bitcoin, experience a nominal price explosion that preserves their purchasing power. They don't get richer in real terms, they simply don't get poorer. This effectively closes our mechanism map for the final time. We started with the funding source, the dormant equity gap between 42.22 and the market price. We moved through the intermediary, the Treasury issuing new certificates to the Fed to monetize that gap. We end at the macro outcome, a recapitalized sovereign balance sheet and a diluted currency. Arrow 1 is the law, Gold Reserve Act. Arrow 2 is the accounting, certificate issuance. Arrow 3 is the result, financial repression. So, what is the next step for the individual? The goal of understanding this mechanism is not to become a gold bug or to build a bunker. It is to recognize that the unit of account you use to measure your wealth, the dollar, is a variable, not a constant. The strategy historically has been to minimize exposure to long-duration currency risk, bonds, and maximize exposure to assets with no counterparty risk, commodities and equity in productive businesses. You are not betting on the end of the world, you are betting on the history of government incentives. When faced with the choice between default and devaluation, they always choose devaluation. The revaluation of gold is simply the mechanical lever they pull to execute that choice legally. The timeline for this is not set in stone, but the signals, central bank buying, the interest expense spiral, and the dormant accounting facility are all flashing in unison. The $42.22 price tag on the books in Washington is an anomaly that cannot persist forever. It is a dam holding back a flood of liquidity. Eventually, the dam breaks. The only question is whether you are standing downstream, holding paper, or on high ground, holding the asset that sets the price. For those interested in the deeper plumbing of how central banks are attempting to introduce a new digital layer to this system, specifically looking at the Unified Ledger project from the BIS, that is a mechanism that deserves its own dedicated breakdown.